Prop firms have grown rapidly in popularity over the last few years, and larger investors and traders are taking note. Larger traders are starting to lean on prop firms as an important part of their trading portfolio, and that begs the question, are prop firms still a good investment in 2024? Prop firms are a great investment, I think, for profitable traders and investors, providing they are able to generate small, consistent returns within the markets. In this video, we will be assessing prop firms as an investment opportunity to weigh up the pros, cons, and due diligence needed before adding prop firms to your larger portfolio or trading approach. So, let's get into it. Prop firms, if used correctly, can make a great part of a trading portfolio. When used incorrectly, they're no different to gambling your money in the casino. Profitable traders have been quick to realize the utility of prop firms in long-term investing. You're, in theory, able to invest just a few £100 into a trading challenge to have hundreds of thousands of dollars in liquidity use. Every month, you can withdraw your profit split and move it to a safe, traditional investment such as bonds or a high-interest savings account, so you're less exposed to the markets. As you can see, if you're profitable, there's a huge amount of utility here, while that should not be ignored. Prop firms can be a great part of a wider investment or trading portfolio and should be certainly considered, providing you're working with the right prop firm. Here are some of the benefits of including prop firms in your investment approach. The first is the ROI, which is brilliant. If you're a profitable trader, the ROI of prop firm funded accounts is brilliant. Let's say you're generating average returns of 1.5% per month in the markets, you take a 200,000 evaluation and pass the challenge. With Lux Trading Firm, for example, that would cost you £599. Your first month of trading, you would return $3,000. You would take a 75% profit split, resulting in $2,000 in your pocket. Plus, the fee of the challenge is returned through stage 1 and stage 2, meaning after 1 month of being funded, you're above the break-even on the prop firm investment and it's purely profit from this point onwards. Spending those few £100 to have access to $200,000 in trading capital is a no-brainer if you're profitable. Second benefit, I believe, is no need to compound externally. Prop firm accounts do not require compounding, meaning you can take your bi-weekly or monthly withdrawals without being concerned that you're slowing progress, depending on the prop firm. You are then free to tax your profits and invest elsewhere, generating further returns from a diverse range of sources. Number 3, scaling is possible. Some prop firms offer capital scaling. For example, with Lux Trading Firm, for every 10% of profits that traders earn, their capital doubles. This means you can grow this part of your portfolio much faster than you can any other part. And number 4, it is possible to automate. It is possible through use of software to replicate trades taken on your prop firm accounts, although lately we have seen this be banned and, for example, Lux Trading Firm never allowed copy trading. So, although this does increase your risk exposure, it is something worth considering. But you have to be careful that you choose a prop firm that actually allows copy trading. And number 5 is the very low risk. When you're trading with a prop firm, you don't have your own capital in the account. Therefore, the risk to you is very minimal. Pretty much only the valuation fee. Regardless of trading performance, the worst that can happen to you as the trader is to have your account disabled for violating the rules or the drawdown limit. There's no monetary risk there. More importantly, this frees up your personal capital to be invested elsewhere. But it's not all just sunshines and rainbows. There are cons to using prop firms as part of your portfolio. In fact, there are a few negatives that you need to consider when making this decision. Number 1, prop firms can go bust. It's no secret that some prop firms have gone bust over the last few months, notably my Forex funds. That was probably the biggest one. This is a risk to traders that are thinking long-term. You don't want to be wasting months with a prop firm for it to be shut down the next month. However, this chance can be greatly reduced by working with a prop firm that offers real trading capital, like Lux Trading Firm, for example. Real money prop firms get paid from profitable traders, meaning they do not need more traders to sign up to earn money, and they're entirely self-sufficient. Whereas demo prop firms need a constant churn of new unprofitable traders to pay the withdrawals of the profitable ones, meaning at one point, when the new supply dries up, these firms will crumble overnight like we have been seeing recently. Number 2, the prop firm challenges are expensive. If you're not a consistently profitable trader, the chances are that you will be taking multiple prop firm challenges in order to become funded. This can end up costing traders a huge amount of money, as prop firm challenges are not cheap, especially with real or reputable prop firms. It's worth noting that most prop firms do offer a partial refund on the challenge fee if you pass and get funded. Number 3, prop firms have rules in terms of drawdown, losses, which limit the volume you can trade and risk within trades. Ultimately, this keeps both you and the firm much safer. However, it does mean your risk tolerance has to be fairly low whilst trading prop firm capital, so that is something to bear in mind. So, how do you select a prop firm to work with? Selecting a prop firm to work with needs to be something you take seriously. Conducting due diligence is incredibly important, as the prop trading firm industry is currently still unregulated. Therefore, you need to ensure you're working with a reputable prop firm that has your best interests at heart. There are a couple of things to consider. For one, definitely their reputation. Second, the age of the prop firm. The prop firms that have been around have a higher chance of actually staying around. And number 3, and I think that's most important, is the funding method. The way in which you're providing with funding is incredibly important. If you're offered demo accounts or simulated funds or virtual prop firms, it's likely that the prop firm is a pyramid scheme. If a prop firm is providing you with real capital, that means the prop firm is not a pyramid scheme, and it's more likely that the prop firm will stay around and actually provide you with real funding. So, in summary, are prop firms a good investment? They can be, but they don't have to be. It kind of depends on how successful you are as a trader, and you have to ensure that you're working with a prop firm that has your best interests in mind. That's gonna be it from me for today. I'm gonna leave you to make your own opinion on whether prop firms are a good investment or not. I would love to hear your thoughts in the comment section down below, and I'll see you in the next one.